That is the opening bell on the New York Stock Exchange this Friday. President Trump's trade war is intensifying with China, raising tariffs on U.S. goods to 125% starting tomorrow. The total U.S. tariff on Chinese goods is now 145%, and we are starting the day with the Dow down about 80 points, almost 90 points. Let's bring in our chief business correspondent, Rebecca Jarvis, for more on that. Rebecca, what do you make of what we're seeing in the markets so far over the course of this week and the developments that have happened over the course of the week with this trade war?
Yeah, Diane, I can tell you this is one of the wildest trading weeks I have seen in my career, and I've been doing this now for almost 2 decades, and I covered the financial crisis in 2008 and COVID. This is just a market that has been completely thrown for a loop. We came into all of this with the tariffs being much higher than Wall Street was anticipating. Then we got the pause. That created a bit of momentum to the upside, but the reality is it's a pause. It's a reprieve. It's not a resolution. And there's still all of these giant unknowns. And then when you see the tit for tat going on between the United States and China, the fact that tariffs now on each country, both countries are throwing tariffs at each other above 100%, that basically means that trade between these two places is at a standstill. And here in the United States, that has a big impact on companies, small businesses, also big companies. It also has a big impact on farmers who export their things like soybeans to China. And then for China, it means that they aren't going to be receiving things, necessary things like soybeans, things that they rely on as well. Some American culture. They've even said they're not going to be taking Hollywood films or as many Hollywood films in China. So you've got this gigantic, truly the state of play right now is mostly between China and the United States. The rest of the world is still an issue, but it's mostly focused on China and the U.S.
Wait, that's a lot to factor in. What are investors telling you about how they're approaching this right now?
Well, I can tell you this morning, the mood is really a feeling of exhaustion. I mean, it's been a white knuckle ride all week long. Even we see it in the futures before the opening bell. They were up, they were down, and now after the open, things are down again. And there are a variety of different factors. Yes, we've been talking about China, and obviously China adding those tariffs on the United States, now totaling 125%. This, of course, follows the White House clarification that the tariffs on China are 145%. Now, China did also suggest that they wouldn't be raising that anymore, saying that there's at 125%, there's no real market in China for U.S. products beyond that. So what difference does it make? And some traders I spoke with suggested that maybe that's a door opening, an opportunity for a negotiation if we're kind of like stuck, if the tit for tat, blow for blow has sort of paused at this level. Maybe at some point there can be a discussion with China. But there are a few other factors going on today. We know that many of the big banks are reporting their earnings. Some banks have reported better than expected earnings for the first quarter. But we're also hearing from CEOs like Jamie Dimon of JP Morgan Chase, who highlighted the volatility, the instability, and the idea that there could be slowed growth in 2025, talking about companies perhaps pulling back, being afraid to invest in their products or acquiring other companies with the uncertainty that we're facing right now with these tariffs. So of course, China, that part of the trade war, that reality is setting in. It is escalating. It is here to stay. And then on the other side, they're also coming to grips with the fact that tariffs are here to stay on some level. You have the reciprocal tariffs at 10%. On top of that, you have the 25% tariffs on imported cars, car parts, steel, and aluminum. And effectively, that's going to mean higher prices for Americans in the future. And we could start seeing some of those prices on things like produce very soon, Diane.
So, Rebecca, what can we do about that, right? It's one thing to be in leadership. It's another thing to be just us trying to figure out how we navigate all this. So for the average American household, what can they do?
You have to think about the things that you can control. There's an entire ballgame happening out there, and it's creating havoc for potentially your 401k. If you're looking at that 401k, number one is to think of it as long term. That's why 401ks are meant to be invested over the long term. I recognize that's easier said than done if you're approaching retirement right now. For people who have a nest egg outside of the market, not a 401k or an IRA, put that money into a high yield savings account by an FDIC-backed bank, or into a CD. You have to be willing to part with the money for a while. But in that case, you're looking at guaranteed upside as much as 4, even 5% more safe in an FDIC-backed bank. And then when you think about your buying and your spending, there's certainly ways that you can be more budget conscious, but you can also be looking at the fact that, as you just heard there from Whit, some places like groceries are potentially are seeing the increases very near term, but other areas, clothes, shoes, autos, these are areas that might not hit as quickly, maybe in the next couple of months. So if you are thinking, hey, our car needs a repair, take it to the mechanic today instead of waiting for the next 3 months. Also, purchases that you might need to make 3 months, 4 months, 6 months from now, if you have the budget, and of course, that's a really important part. Don't take on new credit card debt, because credit card debt is more expensive than the tariffs are at this point, given where APRs are. Make some purchases now. I'm not talking about stockpiling or panicking. I'm saying if you know an expense is coming up, you might as well make that purchase now.
All right, Whit Johnson, Rebecca Jarvis, thank you both.